Welcome to this LexisNexis Risk Solutions webinar, The True Cost of AML Compliance in South Africa. I'm Mary Windishar, and before we begin, here are a few brief announcements. This webinar is being recorded, and an on-demand link will be sent to all attendees after the webinar. Today's event will be interactive, so please disable any pop-up blockers you may have installed. They can interfere with certain aspects of our web conference. For an enhanced view of our presentation, click the Enlarge Slides button located in the gray bar above the slide window. To download a PDF version of the slide presentation, just click the green folder icon located at the bottom of your console. You can ask a question at any time. To submit yours, please click on the Q&A icon at the bottom of the screen and type it into the question box area that appears, and then hit the Submit button. Today, Donovan Byrne of LexisNexis Risk Solutions is joined by Chris Ryman of KS&R. Over to you, Donovan, for instructions, and welcome.
Good afternoon, everyone, and welcome to this webinar, as Mary said, on the results of the recent LexisNexis Risk Solution True Cost of AML Compliance in South Africa survey. I'm Donovan Byrne. I'm the Business Development Manager for LexisNexis Risk Solutions based in the Johannesburg office. And I'm also joined by my colleague Chris Foy out of our London office. And also Chris Reifman from KS&R. Chris Reifman, if you'd like to introduce your side on the company as well.
Thank you, Donovan, and welcome to everyone. My name is Chris Ryman. As Donovan mentioned, I'm with KS&R. We are a global market research firm. We're located in the United States. Myself, I have a number of years' experience in consulting on the technology and the financial risk management space, and I'm really looking forward to sharing the results of the study that we helped and supported LexisNexis with. So with that, let's first of all talk a little bit about and take a few minutes to understand what were the objectives of this research and the scope of who we surveyed, and some definitions that will be helpful to know when we're looking at key findings. The overall objective of this study, the true cost of AML compliance in South Africa, is, as its name indicates, to really determine what the total cost of AML compliance is across all of the different kinds of financial organizations that operate in the South African market. But along with that, to understand what is driving those particular costs. So the drivers and the influencers that are impacting organizations to undertake compliance activities, to understand the spending trends for AML compliance, how these costs are divided across different kinds of compliance activities, how that looks in terms of the involvement of technology and human resources, and the time involved in processing for due diligence. In addition to that, it's helpful to understand what, in fact, is the business impact of AML compliance, which is very timely given the FICA amendments that has gone into force in the last year, and to identify the challenges as well as opportunities for AML compliance and where the role of technology can help along the way. We conducted an online study with 59 decision makers within financial crime functions who would oversee KYC remediation, sanctions monitoring, and or AML transaction monitoring. The surveys were conducted in mid-January to early February 2018, so it was after the FICA amendment had come into force. As we go through here, you'll notice that I will talk about different kinds of organizations, and included in the survey were those who represented banks, investment firms, asset management firms, and insurance firms. We did not identify LexisNexis as the sponsor of the research in order to lessen any potential bias that might come along with knowing who the brand is. As we go throughout today, you will hear me refer to large or small organizations. And what I will be meaning by that or referencing by that is when I talk about a large asset size organization, I'm talking about one that has 50 billion or more US dollar in total assets. Anything under that is small or mid. Small is under $10 billion in total assets, and in between is mid. Also, we'll talk about organization sizes. A large organization for this particular study is defined as having 50 or more full-time equivalents, full-time employees on their compliance teams, and mid or small is under that. Lastly, there is a full report with lots of details available, and we won't have time to go through all of that, but during our time today, we will look at the cost of AML compliance, who is getting hit by that and hit hardest, what are the drivers and the challenges and the benefits of these initiatives, and the impact on organizations. So with that said, let's take a look at key findings, what is the story, and then we'll dive into more detailed look at some of the numbers here. So from an overall perspective, the true cost of AML compliance across all of the financial firms operating in South Africa is just over $2 billion US dollars within a given year. And that's hitting both large and small organizations, albeit in somewhat different ways. Labor does constitute a significant bulk of this. But there are a lot of different activities where these costs are spread across. Larger organizations are spending more, have higher outlays per annum, and the costs are expected for any organization to continue on an upward trend. We will see that regulatory compliance is the key driver of compliance initiatives, and that regulatory reporting and customer risk profiling continue to be key challenges. With stricter compliance requirements, this is translating into longer due diligence time to clear any new accounts, which also is affecting job satisfaction and productivity. And as we go through the findings, we're going to see that what I've just talked about is not just related to banks. It's also related to other kinds of firms, including insurance firms who are getting hit. So let's take a look at some of the more detailed findings here. Let's start out by understanding the organization sizes and structures that are part of who participated in the survey. In the dark green, that refers to large organizations in terms of total asset size, 50 billion or more. Not surprisingly, they have significantly larger compliance teams. And yes, they are screening more names per day, so they have higher volumes. But the fact of having larger compliance teams is not necessarily just because they have more assets and not just because of the nature of that involving larger volumes. It's also based upon having a structure in which they're using separate teams to conduct compliance screening and then conduct sanction screening. Other organizations, particularly more of the smaller mid organizations, tend to be using the same resources across compliance and sanction screening. We find much more as in the South African market as we scale up in assets, the structure changes, including when we get to the banks. Let's take a look at how different team sizes that are handling due diligence volumes. We have two charts here. The top chart shows the average number of new accounts opened monthly by different kinds of accounts, domestic retail, domestic large corporate, foreign corporate, etc. The bottom chart shows the average hours required for completing due diligence for an individual account, whether that is corporate or it is business. If we look down at the bottom chart, we see all the way to sort of in the middle to the right, the bar charts start to get longer. And what that's telling us is that as we look more at business accounts, they require somewhat more time than individual accounts do when it comes to completing due diligence. That's not surprising, since business accounts, as you know, can be more complex and more obtuse in terms of the hidden relationships and subsidiaries and ownership. It takes more time to try to weed through those relationships and beneficial ownerships and so forth. It's also larger banks. If we look just below the bar charts on the bottom chart, we see larger banks with these red boxes. They are, again, using separate teams. They are also logging significantly more hours to clear any one individual account than other organizations are. What that suggests is that there are some level of inefficiencies in the process that can extend the hours to clear any one individual account and therefore obviously have an impact on costs for compliance. If we look further down at the bottom row, insurance firms also are taking significantly longer to clear certain business accounts, particularly domestic corporate and foreign corporate. So as we tease these out, we can see that larger corporations and insurance firms may have some challenges in terms of process efficiencies that could be impacting their time and perhaps also their compliance costs. So this is a good segue into what's really driving the need for AML compliance. You've all lived through the last couple of years of discussion around the FICA amendment, and now it's in force. And that seems to be really related to the answers we received when we asked people to rank what's the top reasons for you to undertake AML compliance initiatives. The chart you see here is the top 3 reasons for AML compliance initiatives. That includes regulatory compliance, improving business results, and also managing reputational risk. But it's really regulatory compliance that is the key AML compliance driver. If we were to filter this chart down to just the top number 1 ranked, we would find that just under half, 41%, had indicated that regulatory compliance is the driver for their AML initiatives, much higher than any other one factor here gets in terms of ranking. And I think that is heavily driven by the recent enforcement of a FICA amendment, the introduction of a risk-based approach that has really tightened due diligence and compliance standards, making KYC be something much tighter than just verifying customer identities, but to really understand that customer and to meet or exceed standards by FATF, which, as many of you are aware, put pressure on passage of this legislation. And you're aware, I'm sure also, that the accountability and liability is much tighter than it has been because of this. So that could also be a reason that as we look farther right on the chart, there's a green bar, 27% said business de-risking is a key driver. Well, if we filter that a little bit further, we find that nearly 2/3 of insurance firms ranked business de-risking as a top 3 driver for their initiatives. And that could be, in light of the recent FICA amendment, and the changes and the tighter regulations, they may be taking a more conservative approach. They may not, in fact, have the same processes or the same systems that banks have traditionally had, so that may be making them feel a bit more conservative in their approach. Whether we talk about banking or we talk about insurance or asset management firms, when we do talk about de-risking, it is one of those balancing acts. It's one where a risk-based approach, obviously by definition, requires organizations to be very diligent to reduce the risk, but not do so in a wholesale manner where being too conservative, as an example, can cut out whole sectors. And that then can cause negative impacts on those sectors, which essentially just raises the scrutiny level of the regulators and can also incur some reputational brand damage. Donovan, do you have any insights further onto this that you might see in the market?
Yeah, I mean, I think, Chris, what you mentioned around the insurance sector is probably what we're seeing there. From my experience, not most of the firms, but a lot of the firms don't have the same processes and that the larger banking financial institutions have. So I think to your point, yeah, I think they may be taking a much more conservative approach here.
Yeah. So as we talk about regulatory compliance, let's take a look at who is viewed as really having the most impact in terms of the regulator and the organizations. And this probably is not going to be surprising to people. The top chart is the regulators who have the greatest impact. The bottom chart is the organizations that have the greatest impact on regulatory compliance. And the top ones who come out in terms of ranked number one is FICA in terms of the regulator, and South African Reserve Bank as the organization having the greatest impact. And both of these do tend to govern the financial sector. It is worth noting that on the top chart, just under a third, 28% of mid-large sized organizations also pointed to U.S. regulators as having an impact on their compliance. And, as they presumably have larger global clients, they are going to be impacted by foreign regulators. And notably, the U.S., which has imposed a number of sanctions over the years, that financial organizations really need to be careful when they're dealing with international transactions and making sure that those transactions don't bump up against networks of U.S. firms, so to speak. So it's not surprising that they've got a bit more of a balancing act here. Moving along, if we look back on the last 24 months, and again, this is including during a period when the FICA amendment was being debated and then when it was introduced and came into force, the cost of AML compliance on average has been stated to have been increasing, about 14% on average. There's an expectation that the regulation and the oversight, the need for due diligence, the need for compliance is going to increase. And along with that, there's an expectation that a similar upward trend of cost of compliance will ensue. So 12%, which is very close to trending with the 14%. Expect this to go up. It's not just volumes, though. When we talk about the volume of regulation, it's not just that can put pressure on compliance teams. It's also the added accountability and the added liability that really puts strain on compliance teams, puts stress on them. And for some functions and where they sit in the front or second lines, these are new kinds of pressures on them. It's not surprising then that we see a significant majority, just over 2/3, indicate real concern about the job satisfaction, or I should rather say the job dissatisfaction among their teams, and how they link that to lost productivity. On average, across all who we spoke to, there was just shy of 3 weeks worth of lost productivity on average due to job dissatisfaction. These kinds of stresses, more volume, more accountability, more liability, and trying to keep up with it. And we know from earlier slides there's longer hours that are being put into due diligence. It suggests that, in fact, actually, when we look at even larger organizations, when we scale that up to firms that are very large asset size banks and they have larger compliance teams, they're telling us that estimated lost productivity due to job dissatisfaction is even higher, around 4 to 4.5 weeks. What that suggests is that financial decision makers in this space recognize that there is need for ways to support their human resources and to help them gain a more efficient foothold, especially as they're going to continue to face more regulation and more pressure and more accountability. And that there may be a point of diminishing returns without augmenting human resources with solutions or tools or technologies that can really help them and aid them along this way. And if we think about or continue to talk about technologies, you can see on this slide, there were a number of technologies that we asked survey respondents to indicate what's currently being used, what is expected to be part of the compliance support process in the next 5 years, and what isn't relevant. Current adoption of certain technologies that we tested still seems to be emerging, but there are a number of them in the blue and orange bars that suggest there's an expectation these technologies will come into play, be part of the process for supporting compliance teams at some point within the near-term future. I think of particular interest here is we look at the two at the bottom, the cloud-based KYC utilities and the shared interbank compliance databases. Very small use or current use of those, at least stated by those who participated in the survey, but quite high percentages of those who expect these to be opportunities within the compliance process support area within the next 5 years. And these are particular kinds of technologies that can be very helpful to compliance teams. They can provide access to information that really gives teams a much broader set of data and access to information to really know and understand their clients, hence meet the KYC requirements and the resource due diligence times. So knowledge is power, and these two particular technologies help to support that.
Yeah, Chris, sorry. On this, I think what's interesting here is, especially with the new technologies, how South African firms are looking at new technologies coming out, and how this probably mirrors a lot what's been done in the European and international markets. So we sometimes see down here in South Africa a bit of follow-through from new technologies launched elsewhere, implemented locally. Very good point. Thank you.
You know, as I was mentioning information, this segues into the various sources of information that we see being used in the market to help with compliance, to screen against or screen for customer due diligence. And there's a a variety of types of information as you see. We believe that with the new FICA amendment rules, sources such as PEP list, sanctions list, state-owned entity data, they're going to become even more important, even though a majority are not using these as yet. These are going to be sources of information that are going to be critical to helping people really understand the relationships that are going on, especially within within the different kinds of accounts that are slowing them down in the due diligence process. What's particularly interesting, though, is if you look at the far bottom of the chart, adverse media is not an information source that is being widely used. Yet with changes in local and global regulations, adverse media is a really important source for KYC. It really opens up the window around understanding the risk that any one individual or any business or relationships might pose, and it really takes sort of the compliance process from being a tick-off-the-box activity to one that's really more proactive because it provides that information. What we don't know, because we didn't survey 2 years ago, is how the sources of information that were financial organizations used 2 or 3 years ago, how that might look different from now given the changes in the regulatory environment. Donovan, anything more you would ask or add here? Or Chris Foy, for the matter?
Yeah, I suppose I'll mention a couple of points, just highlighting some of the sources listed here. So in terms of adverse media, because you just mentioned that, I think one of the things, I mean, we're seeing a lot of interest around adverse media within South Africa. We get a lot of requests around that, and it's really around the importance of having adverse media in a structured format. So if you look at the bar above, you know, using a search engine to look for potential risk on individuals, especially if they have a common name, you know, you're going to have a huge volume of results. You're going to have to pinpoint that it is actually the individual that's your customer, and then you're going to have to determine what the risk is and link all those results together. So really what we're seeing in the market is interest in having that information in a highly structured manner that has been reviewed by a research team where the risk has been assessed and provided to our customers so that they can do screening of all their customer base across that segment. So we're definitely seeing, so I was quite surprised with the results in the bar chart because we're seeing quite a lot of interest, but maybe it is at that interest stage rather than complete adoption. The other area, because of the FICA amendment, that I think is very important is obviously politically exposed people, or as you describe it in the legislation, PIPs. And there, you know, you've got your requirement around domestic PIPs, which is quite an extensive scope in terms of the way that is defined. So it's really, again, having access to reliable data that can provide that information, again, in a structured manner, because it's got to work with technology to complement your processes as well. So those are probably just 2 points I wanted to highlight there.
Thank you, Chris. I think that's, you know, it's all very interesting and all very timely. Let's move to talk about, again, about average hours to clear types of activities. I talked previously about how large organizations, larger banks were taking longer than others to conduct due diligence. I also pointed out the insurance firms were also struggling with some of those time efficiencies. And that shows up again here when we look at, in fact, the time to conduct or clear AML transaction monitoring. Across organizations, whether it's due diligence, sanctions alerts, periodic watch list, AML transaction monitoring, it's somewhere around that 11, 10 hours. And we know that that changes depending on how we filter that and look at it by organization size. With insurance firms, though, it's taking them nearly twice the amount of time than others to conduct AML transaction monitoring. And again, not wanting to repeat what I've said before, but that could also be a function of perhaps not having the systems and the processes in place that banks do at this time. Those who we spoke with certainly expect the alert volumes to increase, on average around 16% over the next year or so, and insurance firms are somewhat more inclined, expect somewhat more of an increase. So I think there is some concern, not just among banks, but I think also among the insurance sector as well.
Just maybe a couple of thoughts on this one, and I'm not 100% sure if I'm correct in this, because I was looking at this slide, and in particular on insurance, and trying to figure out why would it take insurance firms longer to clear transaction monitoring alerts. And one of the points is the one you raised. It could be an efficiency question. The other point is, I'm just thinking with insurance, the types of alerts they may be receiving is maybe a bit different because it's transaction monitoring across various policies. So just by the very nature of the business they're in, it may take longer to actually clear those alerts because maybe further investigation is required. So I'm just trying to give two perspectives on potentially that stat that you have within this slide.
Well, and those are salient points, because as we go to the next slide, we're going to see those numbers in action. We're going to see that idea put into numbers, something that's really quantifiable in terms of their perception around the impact on business. Across all the firms that we spoke with, a significant majority indicate that AML compliance has a negative impact on their productivity as well as on customer acquisition. And if we look at the middle chart below, what we mean by this negative impact, and we talk about it takes longer, or there are particular kinds of accounts or activities that will take longer depending on the kind of organization, that has an impact on the onboarding process. And a significant amount of people that we spoke to indicated that they're losing anywhere between 1% to 4% of prospective customers based on that friction during onboarding. That is in the middle chart. If you add the dark green and the light blue together, that gets us just over 3/4. If we look at insurance firms, it's even higher. There's even more of them that are up to 1/4 are saying that amount of loss for prospective customers goes up to even 6%. So the impact seems to be hitting them even further. And across the board, it really shows that process inefficiencies are impacting both the top and the bottom line. We want to talk about challenges. Oh, Chris, go ahead.
Yeah, I'm just going to make a couple of comments on this slide. So I've been involved in a number of conversations, both in Asia, Europe, and in South Africa, where actually this kind of onboarding process, the time to onboard, the risk of customer abandonment, the risk of introducing too much friction into that onboarding process, we're starting to see customers view that as a potential opportunity, in the sense that if they can optimize that process, if they can make it more efficient, they can potentially gain a competitive advantage because they will be able to onboard customers more. So we're getting more involved in those types of conversations around how we could use technology, how we can use an efficient screening technology to really try and drive efficiencies through that onboarding process. And really with the aim of, what are the ways that we can reduce friction? Whether that's integration within all the core platforms which you're onboarding customers on, and those type of discussions that are happening. So, and the ones that kind of lead in the way in this are fintech companies. So in the fintech sector, obviously, they're setting up these processes for the first time. They are sometimes challenging more traditional financial institutions. They're trying to figure out what their niche is, what is going to be their competitive advantage in the market. And one of the things they're very keen to do is obviously make sure that onboarding process is as seamless as possible. And the other thing that they're having to do as well is make sure they are aware of the regulation. So historically, some of these fintech firms I would say they weren't fully aware of what was required. So they're developing their understanding, and they're looking at how they can automate these processes and drive efficiencies.
Thank you. In a moment, we are going to look at what are the challenges and the impact for regulatory compliance. But first, Mary, we have a poll that's related to that.
That's right. So on your screen right now, you'll see a poll that we would like you to answer. We're asking you to select 3 areas, or up to 3 areas, that are most challenging for your organization when you're screening for compliance. So you'll see a box right next to each answer. Just click the 3 or up to 3 that makes sense for you. Regulatory reporting is the first one, customer risk profiling, KYC for account onboarding, efficient resolution of alerts, sanction screening, positive identification of sanctioned entities or PEPs, and processing non-Latin scripts. So once again, as many of you are doing already, just click the box that's right next to the 3 or up to 3 options that you choose. And we'll give you just a second to go ahead and find out what we've got there for you and choose the 3 that apply to you. Once again, do click it right there on the slide itself. Quite a few to choose between, but you are allowed to choose up to 3. And we'll show you those results in just a second. Thanks to everybody who has participated in our poll. We'll go ahead right now and show you what everybody's thinking and saying. And here we go. Chris, what do you think about those results that you see right there on the screen?
Well, I think it's very interesting. We're going to show you what our survey respondents indicated, and there's some comparison and there's some new things. It looks like positive identification of sanctioned entities or PEPs and customer risk profiling are really coming out on top, and that's followed by sanction screening. It's very interesting. I'd like to take a look and show what our survey respondents indicated. We go to the next page. And the top chart are the key challenges for compliance screening. We did hear and see that financial organizations ranked customer risk profiling very highly, many of them among their top 3. The sanction screening was a bit lower, along with the positive identification of sanctioned entities or PEPs. What we found in our survey was that regulatory reporting was really the key, along with customer risk profiling. And there could be some interrelationship there, along with the other factors. It's interesting because regulatory reporting is a key driver, or regulatory compliance, I should say, is a key driver. Regulatory reporting and customer risk profile as challenges would suggest that there's a need for some additional support in the process, especially in this new era of risk-based compliance. Those with larger teams, 10 billion or more, those with separate teams, or those in the insurance sector were much more likely than others to have ranked efficient resolution of alerts higher among their top 3 than were others. And one can expect that's only going to get worse with increased volumes. We also found that the risk profiling was somewhat more of a challenge. It was significant among all, but it was even more significant among insurance firms. Now, it's not without benefit, though. There is a recognition that whatever pain there might be associated with extra regulation and extra compliance requirements, there are benefits to the organization in terms of having a better understanding of customers in ways that you can manage their risk tolerances, but also manage the relationships and have the data to be able to do that. And that actually aligns with one of the key drivers that we introduced earlier, which is improving business results. So while regulatory compliance, because of the current environment and the new changes, is certainly top of mind in driving, financial organizations are not ignoring the opportunity, or they are not solely focused on the compliance to the exclusion of what are the business opportunities and what are the business results here. It's really just a matter of finding ways to handle the volumes and the tighter requirements in a more efficient and less costly manner. In fact, if we look at the bottom right chart, 11% in this red bar overall indicated that a reduction in straight-through processing exceptions is a benefit. That is getting masked over. If we split that out and look at the larger team organizations, those that have more compliance team members, they are much more likely to have made that one of their top 3 benefits. So again, the thinking on process efficiencies and the way to also help and improve the business. And related to process efficiencies, we find that larger organizations tend to spend more in compliance than others on average. What we are looking at here is, in the middle of this chart, is the average cost in US dollars in millions spent per year on AML compliance. Overall, it's an average of about 4.3 million. But that really is being weighted down depending upon sizes of organizations. So smaller organizations, those that may have less than 10 billion in assets, or teams that are under 100 FTE, tend to be spending somewhere between 500,000 to 2.2 million on average. Those that are larger in terms of FTEs and total assets are spending between 8 and about 13 million. Those, though, that are using separate teams and therefore doubling up team efforts are spending even more, up to just shy of 17 million. And the distribution of those costs, the labor is certainly a significant component here. In terms of activities, KYC program activities, which involves, as you know, collection of information and screening and analytics and risk assessment, those are things that do involve some manual work. That's taking that represents just about a third of what AML costs are being divided towards. But there's other parts here in terms of SARS, transaction monitoring, investigations, AML compliance management, that are also contributing to AML cost overall. And these are areas that solutions really can reduce some of those costs by augmenting and helping the manual side to become more efficient. We take these averages and we then project up to the total market across all firms in the South African financial sector. We find that the total spend, the true cost of compliance across South African financial firms is just over $2 billion per year. And the blue column to the right clearly shows what one might expect is that larger organizations are bearing more of this in terms of their outlays. They are outlaying more costs. They are spending more. But smaller organizations are also getting hit, and they may be getting hit harder. If we level the playing field and we just look at spend as a function of one's total assets, we can see that smaller organizations, in fact, are feeling a bit more pain with the cost. As an example, firms that have less than 100 million in total assets, they spend approximately 500,000 annually, and that represents between 0.67 and up to 2% of their total assets. In contrast, if we look at very large firms on the other end of the spectrum, 100 billion plus assets, their spend in total outlays is closer to 22 million. But that represents a much smaller portion of their total assets, anywhere between 0.01 to 0.02%. What's at play here, what's going on, is that regardless of one's size of organization, there is likely some basic overhead investment that's required to support compliance operations. And so that's why there is a bit more of a bite to the bottom line for smaller organizations. I would like to open up to Q&A unless anyone else from the LexisNexis Risk Solutions team has any further comments on this slide.
No, I think it's good. I think it's clear. The only comment I would have is just actually on the poll results. So I thought that was kind of quite logical what I saw there, and I'm assuming when people rated customer risk profiling quite high, that's kind of linked into the risk-based approach, the new requirements to really understand your customer and to drive that through the process. I can imagine that the people attending this call, that would be a kind of a challenge just to make sure those policies are defined and implemented. And then the other one I think is maybe not surprising as well is further down there you've got PEP screening. I think that this whole kind of PIP definition and the scope of that and introducing that and making sure that's all implemented and robust and you've got the screening processes in place. So if I've interpreted this poll correctly, I would say that's kind of in line with what we're expecting given the legislation.
Great. Thank you very much. Now we can go ahead and continue on with our Q&A session. It is time for you to ask your questions. If you'd like to ask one, all you have to do is click on the Q&A icon right there at the bottom of the screen. Type your question into the question box area that appears, and then hit the Submit button. And we will try to get to as many questions as we can in the time that we do have left. So let's go ahead and take a look at a question here for you, Chris R. We have an embarrassment of Chris's today. So, Chris, based on the survey results, what do you expect would change if we conducted the same survey 2 or 3 years from now?
Well, it's a very good question. Certainly, I think we will see the cost to be higher than they are now. I would expect the kind of sources of information and even some of the tools and technologies to show up higher in the results. There comes a point where as more volume of compliance requirements floods into the compliance team, that there is need for some tools to help augment that. So I think those are 3 areas where I would expect a change in the future.
Great. And let me ask you one other question about just how to look at all of this. What do you think the biggest misconception about this topic is?
Well, I do think that it takes some time to become comfortable with having tools and solutions help or to implement areas for improving efficiencies. I think there's always some concern around that, even though the numbers will show that it actually helps and actually supports organizations in much tighter, challenging regulatory environments. I would also defer to perhaps one of my LexisNexis colleagues where they think there might be some misconceptions in the market.
So I'm not, maybe not sure I'm answering the same question, but I'll just give you my impressions of this study. So I've seen a number of these studies before. I think what I like about this and the approach here is this is probably the first time where I've seen it broken down by entity type. You know, how long does it take to onboard an SME? How many of those accounts have been opened, etc.? It's quite a granular analysis of what is happening within South Africa, which I think is very useful. There's things in there which, you know, based on the survey findings, I find kind of surprising or interesting. You know, for instance, I think on one of the earlier slides, you have the time to onboard an SME, but actually a kind of a mid-market, larger corporate actually takes longer. I think in other areas I would see it the other way round, in the sense that a large corporate is probably listed, etc. The documentation requirements aren't so extensive given its status. As an SME, generally you find it quite hard to find the information. In terms of misconceptions, I probably can't think of anything. I mean, my point is, what we've done here is we've done this granular breakdown and approach and built up to that overall cost. What I've seen before is a much more kind of high-level approach that just kind of says, you know, compliance costs are rising. Here you can actually see the drivers. And on the previous question, the only comment I would make in terms of how things maybe are changing in the next couple of years or 3 years is on one of the earlier slides, you know, one of the top drivers was obviously regulation. I think it's top of mind at the moment for all our, you know, for all the companies, regulated institutions within South Africa. Assuming no additional legislation comes out in the next 2-3 years, you would expect that maybe that number to drop a little bit because, you know, firms would have analyzed the impact, would have implemented and defined their policies, implemented their processes, and it should get to a BAU state. So those are just a couple of points I would make. I don't know if Donovan, you have anything else you want to add?
No, I mean, I think I would agree with what you're saying there.
Chris, let me ask you one other question. This is for Chris Foy. Do accountable institutions have to risk rate existing clients as a result of this new risk-based approach?
Yes, I believe it extends to all customers. So the whole point of the risk-based approach, you know, comes from the FATF guidance, and the FATF guidance applies to existing and new customers. So it is around, and part of the things that were mentioned, I know Chris mentioned it earlier, around this whole de-risking. And he's quite right. One of the concerns that we've seen in other markets is around wholesale de-risking, where when you implement this risk-based approach and you look at your risk appetite within the firm, what we have seen in the UK and elsewhere is that sometimes kind of whole segments of the customer base are de-risked based on nationality or the type of business, etc. And that's something that I don't think in the amendment, and I don't think there's kind of guidance on that yet, but I think it's useful for the attendees on this call just to be aware that in the US, in the UK, Hong Kong, Singapore, I think FATF, they have all started kind of putting out notices around the dangers of de-risking, emphasizing the importance of a risk-based approach. And so, yes, it would definitely apply across the whole customer base.
And Donovan, we've covered a lot of ground today. What do you think the number one thing is that people should take away from today's webcast?
Yeah, I mean, I think what was interesting is the amount of elements of the FICA amendment that's coming through in these results, and that ties up with what we're seeing, you know, in the market. As my colleagues have said, I mean, I think the regulation is probably here to stay, and it'll be interesting to see further amendments coming out. But you know, looking at the amount of changes and that have come through from the previous one to this, there's a lot for the audience to implement in their processes.
Thank you very much. And Chris F., can we get you to bring us home? Tell us your closing comments today.
Is that to me? I didn't get
Chris F., yeah.
Yeah. So I suppose my closing comments on this is, you know, we're presenting the true cost of AML, and you know, some of the things we're highlighting, you know, we're saying it's taking X number of hours and various other things depending on entity type. So I think the other way to look at this as well is it does present opportunity for individual firms who are willing to look at their processes, and understand how they can drive efficiency, whether that's through the adoption of new technology, whether that's a review of their data to ensure that they have the best data, most efficient in terms of it being structured to really drive efficiencies through that onboarding, or whether it's looking at other areas in terms of identity verification. There's lots of technologies in that space. So there is an opportunity here as well as obviously the cost elements and the various other points that were raised during the presentation. So that would probably be one of my takeaways. Is I think hopefully it's been really informative. I think Chris has done a great job in terms of providing a granular approach and building up to that overall number on the last slide. But I would say that there's also an opportunity there for institutions to improve processes and review those and optimize them.
Great. Thank you very much to Chris R., Chris F., and also to you, Donovan, for your presentations. And by the way, today's presentation and webinar recording will be distributed to everyone who registered and came to today's presentation. So thank you very, very much for attending, and enjoy the rest of your day.